Yo, what is up? It is your boy Benton. We are here for World Cup Wednesday. Great day to be alive. We're going to be getting into the returns of HODLing versus DeFi-ing today. This is actually an old article written back in November 4th, 2019. I think it's still relevant to this day with the DeFi explosion happening, which may be part of why the DeFi explosion is happening. We're going to get into that today. If you have not subscribed, go check it out, Crypto Lively. Give us a like, hit that notification button so you know every time we're posting these up so you can just slide right in, check it out. We also got our merch store. Go check that out, cryptolively.org. We're also posting it all over our Twitter. We got fresh merch. We got fresh teas. We got the bull run is coming, and we got our Tezonian. If you're a big Tezonian fan, check those out. So let's get started here with our analysis of compound Uniswap pools, TokenSets, ETH, and BTC. So some of the biggest takeaways from this article: DeFi applications have provided significant risk return improvements for investors over the past year. Keep in mind, this article was written in 2019, about a year old. TokenSets ETH 20-day Mako outperforms ETH buy and hold and returns while significantly reducing drawdowns. Compound and Uniswap offer attractive yield opportunities for investors holding a stablecoin. These are some of the biggest takeaways, and I think you're going to see as we kind of unpeel this onion here that DeFi is really one of the best solutions for investing and then having your investment grow using compound interest. We love that. I think Warren Buffett refers to it as the eighth wonder of the world. So if it's good enough for Warren Buffett, it must be good enough for blockchain. There's currently over 3 million ETH worth of assets, over 500 million of value locked in various DeFi applications. That number is probably way higher now, considering. This post compares the performance of Compound C DAI, Uniswap's DAI ETH pool, and TokenSets ETH Mako against the baseline of ETH and BTC in the last 11 months. So the first thing here, it starts off with, we analyze the returns of lending DAI on Compound, supplying liquidity to Uniswap's DAI ETH pool, or investing in TokenSets ETH 20-day and 50-day moving average crossover strategies from the 3rd of December 2018 until the 31st of October 2019. So it's about a year. We also present the returns for Ethereum and Bitcoin buy and hold strategies for that same period. So this talks about the Compound, which is a DeFi application. So Compound is a money and market protocol which allows users to pool assets which can then be borrowed after providing collateral. Interest rates are variable and dependent on supply and demand. So for Compound, we present the performance of a 10,000 DAI portfolio and the annualized interest rates for each week. In addition to Compound, DeFi projects like DYDX V2, Dharma, BZX, and Nuo have offered similar returns for DAI, but have been excluded because they only went live during 2019. So Compound's obviously been around the longest. 10,000 DAI, the equivalent of about $10,000. From December 2018 until the end of October 2019, Compound earned a 7.1% return. That's pretty damn good, if you ask me. I think at a savings account, you're making like 0.2%. In the stock market, I think it's averages in between 3 and 5% returns is good, considering the extrapolating the data from these past 6 months, which is an absolute anomaly because of quantitative easing. But neither here nor there, 7.1% return investment on a year, that's pretty damn good if you ask me. So most notably, interest rates started increasing in March 2019 following MakerDAO's stability fee increases. Lower interest rates on other collateralized debt protocols attracted users to move their positions to take advantage of more favorable rates. That's pretty much just saying, look, users found higher interest rates and they were jumping ship from Compound. So Compound's got to remain competitive, but MakerDAO looks like they increase their fees a little bit. So there's been some shaking and moving now for a while here in the DeFi space. Now let's get into the Compound DAI return. So highlighting on the y-axis, we have the actual growth of the money. So it starts down here at 10,000. This red line will take us all the way up, and then we're going to track this back to about $10,700. So that's at like 7% return we're talking about. So this is the interest rate over here on this y-axis. This little gray line is the annual interest rate. So this grows and fluctuates. Looks like we almost touched 16%, but it ends the year right around 7.1%. So you can see this is variable. It will fluctuate throughout the year, but as long as it's not dipping down to 2% here for 6-7 months at a time, like I think that's a great return. I think that's an awesome return. So really cool insights there for the compound DAI returns. Now let's get into the Uniswap pool returns. Uniswap is an on-chain exchange that users can use to trade tokens. Trades are matched from asset reserves supplied by liquidity providers who can earn returns on trading fees. In practice, this means that the investor supplies $5,000 worth of ETH and $5,000 worth of DAI into the pool. So this is talking about another $10,000 investment. Here's kind of the breakdown of it. So over the period, the Uniswap DAI ETH pool earned a 18.5% return. So we're talking double of the compound, if you recall right here, the 7.1% return. Interesting, very interesting. So if you're putting in a stablecoin, and half ETH, you're doing pretty good there, 18.51%. So realize Uniswap returns are dependent on three factors: assets prices when supplied and withdrawn, liquidity pool size, and trading volumes. And I think why trading volumes is a factor is that you are getting paid a percentage of every transaction in and out of that pool, whether it's a swap, whether it's people putting in, pulling out, you're getting a slight transaction. It could be 0.05%. But every transaction, if your pool is $500 million big, you're making your little 0.05% on all transactions, which is awesome. And that stuff adds up real quick. So that's why that's one of the biggest factors I want to highlight there. So in the figure below, the green columns show the weekly cumulative trading fees, and the red columns show the weekly and permanent loss resulting from price volatility. Interestingly, the fees collected from increased trading activity on days of large ETH price volatility greatly mitigated the impermanent losses on the total value of the portfolio. Another factor contributing to this result is the relatively small liquidity pool size compared to the trading volume, which allowed liquidity providers to receive a large share of the fees. Very interesting. Uniswap DAI ETH returns. Let's see what we got. So impermanent loss is going to be these red bars down here. And then the value of the $10,000 investment starts right here, a little above 10K. We go up and down, and boom, we're ending right under 12K at the end of the year. I'll take that all day. I will take that. Let's see the cumulative trading fees in percent. So 20% here at its highest. So it goes to show you, if you're getting into these pools early, I think, if I'm reading this correctly, cumulative trading fees in percent, your fees should grow. So I think in theory that makes sense, but I'm going to have to double check that one for you guys. TokenSets ETH 20-day and 50-day moving average crossover strategies. And the crossover strategy is essentially, we'll get into it, but just so you know before we get into this, is crossover strategy, anytime the price drops below the moving average of the either 20-day or the 50-day, the crossover strategy is essentially an algorithm that automatically trades your ETH for stablecoin so that it doesn't incur the losses below that moving average. So your investment is only pretty much riding the moving average line. So if it goes above, it'll ride it. And then once it hits that mark or close to that moving average, it'll automatically trade and convert into stablecoin so that you keep your gains. So that's what it's going to get into here. So we present the performance of two trend trading strategies: the 20-day moving average crossover, Mako, and the 50-day moving average crossover. TokenSets released their trend trading strategies in 2019, but we approximate returns for the strategy using daily price data since October 2018. The moving average crossover strategy buys and holds ETH when the price of ETH is above the moving average and sells the ETH and holds stablecoins when the price is below the moving average. The rebalancing transactions occur on the day of a price crossover with the condition that 4 days have been passed since the last rebalancing. So that's kind of what I walked you through earlier, so you kind of have a picture of what that looks like. We note that both strategies mostly avoided ETH drawdown in July 2019 by rebalancing into stablecoins in time. However, September's drawdown was too sudden and both rebalanced into stablecoins too late. The 20-day Mako strategy outperforms the ETH buy and hold strategy by generating a 78.7 return. Wow. But the 50-day strategy significantly underperforms with a 22.5% return. The blue bar below represents daily return. So this is what we're talking about here. So let's see here. So the blue line is So the gray bars here represent when your investment is ETH, and then when it gets converted into a stablecoin. The blue line is going to track your ETH price and daily gains. So this is what that looks like each day. So imagine look at the peak here, $300 for your investment. And I'm assuming this is a $10,000 investment. Just $300 a day just for doing nothing, just for lending out your money and sticking it in a smart contract. Pretty cool to me. I think that's why DeFi, that's why so many people are attracted to that. I mean, just imagine getting those returns every day, and then it just builds, and then you're continuing to build interest on those gains every day. It's the eighth wonder of the world. It's the eighth wonder of the world. 20-day Mako returns you see here starts at 10,000. And the moving average, so this is only a 20-day period, so keep that in mind. So this grows to its peak all the way up to $30,000. That's almost 3 times. That is 3 times a $10,000 investment. Like, holy shit. And if you timed it right, and I think the thing that they highlighted, but I'm going to reiterate, is that ETH had a huge crash in price, I think right during the summer. Yeah, it looked like July is when it happened. So you can see that why this dropped so much. But I mean, still, if you're able to get out at the top, if you're just looking at your investment on a daily basis, oh, okay, where's it at today? Like, if you don't get greedy and you just pull out at the right time, like, you're sitting on 3 times your investment over 1 year. There's like no other place you can do that with. Real estate, whatever. Like, these are just awesome ways to build passive income. All right, so ETH price and 50-day moving average crossover holding periods. So same thing here. The gray areas indicate when it was ETH. This is over a 50-day. So you can see the drawdowns were a lot more over 50 days. But in 20 days, if you can triple your investment, not saying it's going to happen because it looked like there was a bull run and they just timed this right, and just so happened that their sample of data was over that year when they had the bull run. But I mean, still, I don't think this is like a magic thing. Like, you shouldn't expect 3 times your investment. It's a possibility, but just understand the rates you're getting are way higher than any other just basic mutual fund. If you're doing that, if you're just using a savings account, like that money sitting there that you're saving, you're earning like shit on your interest. Like, why not stick it into a DeFi for a year? See what happens. You might blow your socks off. Same thing here. 50-day Mako returns starts around 10,000 and gets up just over, it looks like just under 20K up here. So it was a 20% return at one point. Still pretty fucking good. And then it drops down here. So I'd say this is awesome. This is why DeFi is what it is. This is why it's so magical. And we're kind of unraveling that the deeper we dive into the different strategy here. So now let's talk about the Ethereum and Bitcoin returns. This is just going to talk to us about holding it. Just stick it in your wallet. What's going to happen there? So Ethereum and Bitcoin prices have remained highly correlated, and their performance was largely comparable until July 2019, when Ethereum started an extended downturn trend while Bitcoin recovered. However, Bitcoin followed in September 2019, when it also saw a large downturn. Over the period, both assets peaked at over 200% from their starting values. The price of Ethereum has fallen by roughly 50% from its peak, whereas Bitcoin's price has fallen roughly by 34%. So ETH seems a little bit more volatile. That's all. That's pretty much saying at the end of the period, an Ethereum buy and hold strategy realized a 69.3% return, and Bitcoin realized 131.4% just for holding your Bitcoin. Like, that's another reason why when you're looking at Bitcoin as an investment, this is not investment advice. I'm just trying to drop some knowledge here, but you have to look at the yearly lows of that asset. Bitcoin's yearly lows have grown year over year over year. So that should give you the range in which you should understand, hey, this is the lowest point that my investment will probably go. Now, granted, some sort of anomaly could happen. I'm not saying it's not possible, unlikely, but if that higher low keeps growing every year, that's a great sign for Bitcoin. And 131.4%. You're doing pretty good on your investment for a $10,000 investment. Awesome. Love it. So here, chart just breaks this down for us. This red line indicates the value of this $10,000 return. Look up here. This is ETH. That $10,000 investment, 30,000 just over it, just for sitting on it at the right time. Like, that's why it's so important. That's why I started getting into DeFi, because I was like, this is great. This is awesome getting all these returns, but I don't want to have to sit here and monitor when I should pull it out, when I shouldn't. Like if you're able to stick it into some of these softwares, like you can get these gains, boom, pump them into a stable coin. And then when the price drops, you're back into ETH. You're back in the game and you're just riding this roller coaster up and down and just timing it. And that's part of what some of these new DeFi apps are doing for you. Some of them are not. But still, it is about not being greedy and just understanding the numbers. Because if you see the numbers on your investment, you're like, holy shit, I just tripled my investment. Like, why do you think it would go even higher than that? Like, even if you doubled your investment 20 days, like, I would probably look at pulling it out and turning it to a stable coin and then reinvesting once the price drops. Like, I don't know. That's just me. Not a financial expert. I'm just trying, like I said, drop some facts on you with this article. I found it absolutely fascinating. Same thing with Bitcoin. Look, red marks up here, just over 30K. Like that's why you love Bitcoin. Keep in mind though, there was a lot of volatility here at the end of the year, just north, but still doubled in value. All right. So the ETH 20-day strategy outperforms the other presented DeFi strategies in the ETH buy and hold strategy on an absolute basis. This results from the strategy avoiding most of ETH's drawdowns while generating returns during the uptrends. We talked about that. 50-day strategy similarly captures ETH's uptrends from March and rebalances into stablecoins in July, but experiences a large drawdown in September, which significantly lowers the strategy's final return. So as you saw, like the algorithms have to wait 4 days for that trend to actually be a trend. So that's part of why that drawdown happened with that 50-day moving average as opposed to the 20-day moving average. So the 50-day strategy would have returned over 50% and the 20-day over 130%. Like, that's crazy. That's absolutely crazy. To me, like, you can't find a better investment than that. That's a vehicle. That's a Ferrari fucking investment vehicle. So that's why I love DeFi. And that's why it's kind of opened up Pandora's box for me today. I just was diving in here. All right. So most notably, the 20-day strategy has a drawdown of only 1.7% from the original value compared to the drawdown of 26.5% for the 50-day moving strat. Let's see, minus 22.48 for the ETH buy and hold and 18.7% for the BTC buy and hold. However, holding ETH and BTC or TokenSets carries higher risk due to price volatility compared to lending a stable coin on Compound. That's my problem with this is drawdowns. That's fine. I know they're going to come back up, but I get a little nervous when I'm looking at that and I'm like, holy shit, I just lost 20%. Like, it's today the day. It doesn't bounce back. But over history, it shows us it has bounced back. It's just a matter of time. So it's about riding those waves. It's riding those waves if you're buying and holding. And with some of these DeFi strategies, you can mitigate some of those risks, which is awesome. So similarly, Uniswap's DAI-ETH pool liquidity providers hold half of their investment in the stablecoin, which also reduces volatility of their portfolio. For example, Compound C tokens represent a deposit and it's accrued interest, but exists as a separate token. This means that Compound deposit can be transferred and deposited into other smart contracts like Uniswap. A C-DAI-ETH pool exists. C-DAI-ETH liquidity providers therefore earn both Compound's DAI interest rate and the trading fees from the pool. All right, let's unpackage this because I think this is also important. So what this is saying is that when you put your investment in a Compound, they give you like a receipt. It's like, hey, bring this back whenever you want to get this investment. And that's called the C-DAI from my understanding, or the C token. So what's happening is you're putting your investment in Compound. Great. They're giving you a receipt. That receipt now you can take over to another liquidity pool and stake that on top of your original investment. So this receipt you can take and use to also leverage. I don't know what that means. I don't know. That just sounds like you're doubling your risk, which some people are okay with, and you're increasing, you can double those returns. Now, I think there's a point where greed takes over. This is sounding a little greedy because like I said, what happens there's smart contract bug? There's always all the risks with DeFi, but very interesting to see how these products are getting created, whether they're for good or worse. I just think it's interesting. So as far as our analysis, DeFi space allows investors to build different risk return profiles to seek out promising opportunities. So let's see. So this chart does a great job of breaking things down for us. Over here on the left is all of the different strategies. You can see the final value of the investment after a year of holding it in their different types of strategies. So you can see Bitcoin was king here. So buying and holding Bitcoin, this chart does a great job because I think it also highlights the importance of holding Bitcoin. I think that's kind of your first go-to, is your bread and butter. Once you have your amount that you're comfortable with, then maybe you start exploring DeFi to decrease some of that volatility. But realized return, 131% just for buying and holding. Its highest value, 31,976. Buying and holding Bitcoin, not very hard to do. Peak return was at 219%. All right, so this is the highest that it got. And if you wanted to, you could pull it out, turn it into stable coin, and then boom, buy Bitcoin back when it drops. So very interesting here, but it's one of those things where this was literally held onto for a whole year. It went to its peak. Okay, great. It was still sat on. And they realized 131% at the end of the year. Now, understand this is only 1 year, and that sample size for Bitcoin, I don't think is big enough because there has been down years. So I think it would be more interesting to do a deeper dive to compilate a year by year since its inception of the returns that you would make if you were holding on to it in comparison to a larger sample size for a lot of these other strategies. And I think that would give you a more round number, a more averaged out number, so you can take into account all of these price volatilities. But this is very interesting. I think this is the tip of the iceberg for DeFi. Fascinating stuff. This just shows you what your investments are doing. The drawdowns here, you can see at its lowest points, this means this is how much it dropped. Lowest value, dropped down. So you can see this $10,000. Yeah, some of you are probably sweating. If you made $10,000 investment, you're down to 7K. Like, a lot of people would start looking at that and be like, hey, I need to cut my losses. But once again, this is all part of the different strategies you can use approaching DeFi. A lot more risk involved. Understand those risks, and we have that little section down here for us. DeFi is still in early stages of development, and all smart contract systems should be considered experimental and highly risky with the possibility of complete fund loss. Once again, risks are there. You have to understand those risks. Be willing to take those risks. This is one of those things where, it could poof that you're pretty much just burning your investment. Could happen. Understand it. It's possible. Investors may be better off diversifying their lending and other activities across many smart contracts rather than optimizing for highest interest rates currently. So I appreciate you guys coming on. I know this was a little bit long-winded, but dude, this article was awesome. Dove into so many different strategies, broke down with the graphs and charts so you can see it. For me, a visual learner here, so I love seeing these charts and understanding it that way. I hope you guys got something out of this. This is kind of the breakdown of DeFi versus buying and holding. So I hope this can maybe lit a little spark under some of you to go take a look under the hood of some of these projects. I know I'm going to be interviewing a few other DeFi projects coming up, and I hope you guys enjoyed today's episode. Thank you for joining. If you haven't, go check out our swag shop. This is going to be, we're selling t-shirts. We got our Crypto Lively gear, and we got our limited edition only available till September 1st. Make sure you get yours before it's gone. And then we're going to rotate in some new designs, some new logos. We're coming to you every 2 weeks with something new. Your boy, Benton. Thank you for joining us today. Like, subscribe, YouTube, Instagram, Twitter. Until next time, over and out.
Here he is again. That's astonishing. It's absolutely world class.